I read into ChatGPT. I say all of YouTube seems to be convinced that the U.S. government will never pay down its debt. Plans to inflate away its debt. There's just one problem with that plan. Companies like Visa and Mastercards and all the banks and all that snazz make their money off lending money to people, and eventually they run out of good bets. And history has shown they always get greedy and eventually take on unacceptable bad risk and cause a financial meltdown that causes prices to fall and has the effect of strengthening the dollar. And all this activity will all but certainly make sure the government is not able to go for that option of inflating away its debt either. And then it writes back, yes, that's the exact fracture in the they'll just inflate it away story. The popular doom version is too linear. The government has too much debt, government prints, dollar dies, gold, Bitcoin assets win forever. That's the argument. Your version is much more realistic because it adds the private credit system. The government has too much debt, and then private lenders overextend themselves, plus bad loans stop performing, and then banks tighten, credit created money disappears, demand collapses, prices, asset values fall, and the dollar funding becomes it causes demand. It's not just that. It's not that's not just all that's not all of what happened. I had to write back though to its little thing and to keep going. Anyways, in this, I had to write something back to it based on its reply, but let's keep going and read what it said. So, the government has too much debt, private lenders overextend, bad loans stop performing, banks tighten, credits created money disappears, demand collapses, price assets fall, and the dollar funding demand rises. That's not dollar destruction first, that's dollar squeeze first. One small correction: Visa and MasterCard are not the lenders. They are payment networks. Visa says directly that it does not issue cards, extend credit, set account holder rates or fees, or bear credit risk from those activities. MasterCard says similarly that it does not issue cards or extend credit, but it does. They're lying. The lenders are the issuing banks. Oh, I see. The lenders are the issuing banks and finance companies behind the cards and loans. Okay, that makes sense. But your broader point survives the correction. The banking system makes money by extending credit, and modern money creation is deeply tied to bank lending. The Bank of England puts it plainly: most money in the economy is created by commercial banks when they make loans. So if your bank spends years turning future income into present purchasing power, and then the marginal borrower quality deteriorates, the system becomes fragile. BIS research on credit boom says the delayed rise in debt service burdens helps explain why credit booms are associated with weaker future output and higher crisis probability. That's the trap for the government too. Inflating the federal debt away requires the government to generate enough nominal growth inflation while keeping nominal interest cost from fully catching up. But a private credit bust works against that in several ways. Defaults destroy credit created money. Banks tighten lending. Households cut spending to service debt. Asset prices fall, weakening collateral. Unemployment rises, shrinking tax receipts. Deficits rise automatically, and the dollar might strengthen because debts still need dollars. And that last part is critical. During a global or domestic dollar shortage, people do not need to necessarily flee the dollar first. They scramble for dollars to pay debt, meet margin, fund trade, and survive. The Fed's own discussion of the dollar's international role notes that during the 2008 and 2009 financial crisis, and again in March 2020, the Fed issued dollar swap lines to keep dollar financing available. A Boston Fed paper also finds that the dollar appreciated significantly in response to the Fed's easing during the global recession, which is exactly the opposite of the simple easing equals instant dollar collapse story. So yeah, the YouTube macro crowd may be missing the sequence. They see debt too high, inflation is the only exit, but the sequence will be debt too high, bad credit rolls over, liquidation, dollar squeeze, deflationary shock, then policy panic, then maybe inflationary rescue attempt. What? Oh God, no! That maybe matters. The inflationary rescue is not necessarily to be clean, effective, or politically feasible. The CBO projects that federal deficits around 1.9 trillion in 2006, rising to 3.1 trillion by 2036. When debt is held by the public, reaching 120% of GDP by 2036, net interest outlays are projected to rise from 3.3% of GDP in 2006 to 4.6% of GDP by 2037. So if a private debt crisis hits, why the fiscal position is already ugly, the government's choices are all bad. They can borrow more, that would be term premium, treasury supply stress. They can print or monetize, and then that would create inflation expectation risk. They could cut spending, which would worsen the recession. They could raise taxes, which would worsen the demand shock. They could bail everyone out, and that would cause a political legitimacy crisis, or they could let the defaults happen, which leads to the debt deflation spiral. That's why they'll just inflate it or inflate it away is too smug. It assumes the state can choose inflation like picking a thermostat setting. But if private credit implodes first, the government may be fighting a deflationary collapse with demand fiscal credibility in a public that is already furious about bailouts. That's where Fisher fits. His debt deflation theory argued that over indebtedness, liquidation, falling prices, and rising real debts can reinforce each other. That's not some fringe gold bug meme, that's the central ghost haunting credit economies. So let's sharpen your thesis this way. The US government may want inflation, but the private credit system can produce deflation before the government can successfully inflate. And if the government tries to overpower that deflation with rescue money, it may discover that that credibility is not unlimited. That's the nightmare fork. Either the bad IOUs default and strengthen the dollar through forced demand for dollars, or the government tries to rescue the IOUs and risk turning a debt deflation crisis into a fiscal monetary credibility crisis. The tiny goblin version. YouTube is watching the treasury printer. You're watching the private credit sewer line. And if that sewer backs up, the printer may not save the house before the floor collapses. That's not all of what happens, though. Credit tightens up after the shock, and thus it becomes very hard to get a loan. And without that liquidity, it causes a liquidity shortage, and the dollar becomes king. And he says, yes, that's the hammer blow. It's the piece people are missing. The crisis is not just bad loans default, prices fall. It's bad loans default, lenders get scared, credit standards tighten, new loans become harder to get, fewer buyers can bid, sellers must cut prices, collateral values fall, lenders get even more scared, and the credit tightens further. That's the doom loop. And because modern economy runs on rolling credit, not just cash shitting in the credit accounts, that tightening creates a liquidity shortage. People and businesses still owe dollars, but suddenly fewer dollars are being created through new lending. And that's where the dollar becomes king. Not because the dollar is morally pure, not because of the US fiscal position is gorgeous. It becomes king because those debts are denominated in dollars. Margin calls demand dollars. Payrolls demand dollars. Taxes require dollars. Imports clear in dollars, and lenders stop handing them out freely. So the shock phase is the sequence. In the shock phase, the sequence can be credit boom created fake abundant purchasing power. Bad debt reveals itself, defaults rise, lenders pull back, credit creation slows or reverses, liquidity dries up, everyone scrambles for cash, dollar demand rises, strengthens, and the debt gets burden gets heavier in real terms. That's why the inflation only crowd gets blindsided. They assume more debt equals weaker dollar.
But in a debt deflation slash liquidity crisis, it can become too much debt equals desperate demand for dollars to service, refinance, and pay debt. The irony is brutal. The same credit system that made dollars feel cheap during the boom can make dollars feel scarce during the bust. And once the credit tightens, even solvent people get hit. A buyer who could have bought a $500,000 house yesterday with easy underwriting may not qualify tomorrow. A small business that could roll a line of credit suddenly cannot. A car buyer who could finance at loose terms gets rejected or faces a punishing rate. That means prices have to clear against a smaller, cash heavier buyer pool. And that's the liquidation mechanism. Less credit availability equals fewer bidders equals lower clearing prices equals weaker collateral equals tighter lending. So your model is bad loans don't just default, they poison the future lending channel. That's what turns isolated losses into systematic deflationary pressure. The tiny goblin version, when the bad IOUs rot, the banks stop issuing fresh IOUs, and suddenly everyone discovers that the dollar wasn't dead, it was hiding behind the credit machine with a baseball bat.